What is going on, Z community? It's me, Tamer, the Canadian version, not the British version. But today we're going to be talking about covered calls. Yes. Welcome to the world of options. Covered calls are probably going to be the first type of strategy that you come across when looking into the options world. So let's talk about it. To do a brief overview of what options are, these are basically contracts where one represents 100 shares of stock. This means that one contract is 100 shares, 5 contracts are 500 shares, and 10 contracts are 1,000 shares. Now at each and every single options trade, there are always two people at both ends, the buyer and the seller. Now before we dive into this any deeper, keep in mind that there are two types of options contracts, calls and puts. Today, for the purpose of this video, we're only going to be focusing on the call aspect of the options contracts. So we talk about a buyer of a call contract. These are people who basically call the shots as to whenever they can buy shares off of you. And with the call option buyer, they have two options, which is either to call the shots and be like, I need those shares right now, or they might not say it at all. The other person in this case is the option call seller. And in this situation, you're actually the one who is forced to sell your shares to the other person. And this could be at the snap of the fingers of the call contract buyer. This means that when the person decides to snap their fingers and exercise the contract, they're basically saying, yo dog, send me some of those shares, my G. But what I'm trying to say is that you basically have no other option but to sell them the shares since you guys both signed the contract. Now this is where we actually get into the covered call strategy itself. With the covered call strategy, you are actually the one who is selling a call contract against shares of stock that you already own. Let's illustrate this a little more by defining each term in covered call. Covered is referring to the fact that you already own these shares of stock. And the call portion of it is just the type of contract that you are going to be selling. Now let's look at this with a bit of an example. Let's just say that I own 100 shares of the RBC stock that I bought at $100 per share. Now, I'm pretty confident that within the next couple of months, it won't go over $105 per share. So in this case, I decide that I want to sell a call against it. Because I know that the chances of it going higher than 105 is pretty low, I'm going to be selling this call contract at a strike price of $105. What this strike price refers to is whenever RBC decides to hit $105 or more, that's when the option buyer can do the snap of the fingers and I'm forced to sell the shares to him at the strike price of $105. Because of this, you decide to sell a call option at a strike price of $105 per share. This $105 is also known as the strike price. If you're wrong and RBC ends up hitting 105 or even more, at the snap of the fingers, the options call buyer will do that snap of the fingers and basically you will be forced to sell your shares to them. Now, most of the time, options call buyers will not ever exercise exactly at the strike price. They're going to wait until it gets a little bit higher. So in this case of the example, let's just say they're planning to wait until $110. Now they might wait for the stock price to go a little bit higher because of two main reasons. The first one being is that they want to break even from the premium that they paid. Now the premium is what any options contract buyer will have to pay in order to solidify the contract. And the seller, on the other hand, is the one who gets the premium. In this example, if the contract buyer ended up paying a premium of $1 per share, that means he would have to wait until the price of RBC is at 106 in order to be at the break-even point. On the bright side, I'm the one who ends up getting that $1, so it's all happy days for me. Unless it goes over $105, then it's like half of a happy day. Now, the second reason that they're probably gonna wait until the stock price hits higher is that they're probably gonna flip it as soon as they buy it off of you. In this situation, if they were to wait until it hits 110, they're gonna end up buying the shares from you at 105 and then resell it for a $5 profit. Now, should you use this strategy? Well, it really depends. I've kind of went over the pros and cons of this specific strategy in a previous video a couple of weeks back. So be sure you check it out and it'll tell you all the disadvantages and all the advantages of using the covered call strategy. It's probably a good idea because I lost a lot of opportunities to make a lot of cash. So be sure to check it out. It's a short one. But Z community, the question of the day is, have you ever done a covered calls play before? Let me know in the comment section down below, and I'd love to hear from you guys. But for now, this is me, Azizz, signing out. Peace.